and welcome to the Daily Finance Wrap, your daily dose of personal finance updates from real estate to insurance to your own money and everything else that to do with your money. Well, of course, we'd love to keep the show interactive, so please feel free to write in with your questions and queries, and we'd be more than happy to take this up with our experts. I'm Samina Nalwala, and let's take a look at the top headlines that we're tracking this evening. It was a tough day again for the bulls on D Street. All sectors declined, with metal stocks leading the losses in trade. Investors turned cautious ahead of the upcoming rate decision from the Federal Reserve following Donald Trump's victory. The Nifty lost 284 points to close sub 24,200. Apollo Hospitals had a good run on a fantastic set of numbers being posted. The broader markets also sold off with the Nifty mid and small cap down 0.7 and 0.5%. But despite today's decline, let's not forget that the Nifty, the Sensex, and the broader markets have had a dream run, with the broader markets outperforming the Nifty with a 25% rally versus the Nifty that's up 13% over the same period. One stock that has been the star of trade and has been insulated from the recent correction is Waaree Energies. But today was an exception. The stock saw a sharp decline of nearly 8% after it hit a record high in trade yesterday. Waaree Energies is up 150% from its listing price in the last 8 days. The stock had hit a record high of 3,354 in yesterday's trade, but continues to trade at a significant premium to its listing price, or rather IPO price of 1,503. Remember, Waaree Energies debuted on the exchanges on the 28th of October and since then has piqued investor interest. Next up, the RBI announced changes to the KYC norms to align them with recent updates to the prevention of money laundering rules. These revisions affect certain aspects of the existing KYC guidelines as per changes to the Master Direction KYC Directions 2016. Regulated entities must now apply customer due diligence at the unique customer identification code level. This means that if an existing KYC compliant customer wants to open a new account or avail additional products or services from the same entity, there will be no need to repeat the CDD process for customer identification. The new provisions come into effect immediately as stated in the RBI circular. Next up, well, it's gold that's been on the sell side. The last time Trump was in the White House, gold prices reacted negatively, declining 8%. This time around is no different, with local and gold prices seeing a big dip. In India, 24 karat gold prices saw a significant decline of 1790 per 10 grams, bringing it down to 78,710. Ahead of the Federal Reserve's rate decision, a stronger dollar is what's expected on back of the fact that the policy action taken by the new government, which is Donald Trump, will be inflationary in nature. Higher inflation means lower rate cuts, which also means a higher dollar, which then means a weaker gold price. That, of course, led to gold prices declining in trade. Well, the last 24 hours, remember, have been action packed with, of course, assessing what Trump in the White House means not just for the world and for policy action, but also for our portfolios. To discuss that with me, I have a veteran in the personal finance space, Vishal Dhawan, founder and CEO of Plan Ahead Wealth Advisors, joining us. Hi, Vishal. It's been a while since we've chatted on. I would have said TV, but I believe the world has changed now and it is more social media, and therefore, hence, a first conversation on YouTube. Vishal, we've all gotten very excited and we were all part of this presidential race for some reason, which was taking place in the mother market. Now that we know Trump is been elected in the White House, let's start with a very basic. Apart from this creating great television and great content, does this have a material impact on my equity portfolio?
Great to be here. So I think we need to sort of break this up into two components. One is really, what happens in the short term as a result of, this let's say, clear verdict in terms of favoring a particular candidate. I think the way one needs to look at this is that historically, if you go back and look at the last 8 elections, uh, typically a week to a month after elections are done, you'd normally end up seeing that markets move in very narrow sort of ranges. So there can be immediate impacts that take place, but those settle down very quickly. This was different the last time that Trump came in. Remember when he came in last time in 2016? He came in unexpected. So the verdict was that you would have Hillary Clinton come in. Actually, you had Donald Trump come in, which was a bit of a surprise. But in spite of that, you did find that developed markets actually did quite well uh, when he came in, and so did all other markets across the world in the short term. Historically, over 8 elections, there's been no impact, but in terms of Trump's last election victory, there were actually some meaningful gains that came through. The moment you start looking out a little bit, saying, I want to think about 1 year and then maybe beyond that, you then start to suddenly see that the picture looks a little different. So typically, whatever volatility happens in the short term, whether it's in emerging markets, US markets, India, tends to all even out, and has historically shown that most of the times markets do quite well 1 year later and beyond. The risk in that model, though, is that it's forgetting about one critical aspect of what markets really should be slaves of, which is how corporate earnings are. And I think we are starting to see pressure on Indian companies as far as their corporate earnings are concerned. We saw that in the June quarter results. We are also seeing it in the September quarter results. So what I would say is, don't focus too much on what happens with election strategies. I think focus more on how corporate earnings are going to grow, and you have to really forget the volatility around the election period, which we've just seen or are likely to see in the next few days, and focus on the medium to long term in terms of equities.
Fair point, Vishal, but the fact remains that, commentary from Donald Trump is so inward looking that for more reasons than one, money will flow back to the US. October became a very tough month, and retrospectively, we found explanation and reasons of why our market sold off. One of them being that foreigners have flocked out of the markets and moved to China because it offers better valuation. Now, China seems to be in the doghouse, which is very obvious by Trump's commentary. Do you fear that with money moving back to the US, the period of uncertainty and pain for Indian markets, outside earnings, of course, may be extended, and hence equities may find it tough to even sort of perform in the next 1 to 2 years? And also keeping in mind that we borrowed returns from the future. The last few years have been phenomenal for equity investors.
No, you're absolutely right. And I think that's why investors need to just step back a little bit and ask themselves, saying that, first of all, when I'm looking at equity, do I have options to buy equity outside of India as well? So why do I have to restrict myself to thinking about equity as only a portfolio which has exposure to Indian equities? The way we look at it is that you have seen how money moves from one market to another. So we saw how, a few weeks ago, suddenly China became sort of a favorite, then it sold off a little bit. You saw how, the US market reacted so strongly to the Trump victory. You saw how India sold off a little bit. So you can see that money is rotating. And if you look at long periods of time, you will find that who gets you the highest return varies very quickly. And therefore, our suggestion to investors has to be that when they think about equities, they have to think about equities beyond Indian markets itself. They need to have global portfolios. Of course, a large part of the money will be in India because it'll be naturally biased towards the home country everywhere. These biases exist. But I think they need to stop thinking about international investing as risk protection. I think somehow the impression that a lot of investors carry, which is not supported by data, is that if I want high returns, I need to be in India. If I just want some protection, I go overseas. If you look at long-term data, you'll find that US markets, for example, have outperformed India very often. In fact, in the last 15 years, at various time frames, they have actually outperformed India. And it's only over 20 years and 25 years that India has outperformed the US when you convert everything to dollar terms. So my suggestion to anyone who's constructing portfolios, already has a portfolio, is please ensure that you are both domestic and international and not only one place.
I agree. In fact, with most people now exposed to the world in more ways than one, you also one have allocations made, but there's also enough and more spending that we've seen with individuals looking to send their children abroad to get educated, or even holidays for that matter. We'll talk about geographical allocations later on in the show, but let's start with what existing investors need to do. Now, if we are anticipating the markets to remain volatile, there will be opportunities to go out and upfront capital, right? But while we are living through that journey, do you think for individual investors, one, of course, you can stomach the volatility, which is primary. Secondly, do you think adding strategies to one's portfolio, which act as a hedge, could be useful to sort of reduce the blow? So maybe a strategy like a long short fund, right? That would help. I would imagine that should help investors sort of cushion what's to come. Do you think that's a good idea or may not be required?
So, two things around long short funds that are important. I think they are very interesting strategies, but we need to keep in mind that typically most long short funds today are run out of AIF kind of structures, which means that you need to have a large minimum quantity, an investment which is at least a crore to be able to participate. The second thing that happens is a lot of long short is done on individual stocks. And therefore, what the manager of the long short strategy has to get right is also which stocks to go long on and which stocks to go short on. And what we've seen historically is that getting that right also is very hard, because you might get direction right of the market, but within the market, because there are individual stocks, you may not be able to get that direction right. So one of the things that we'd like to think about right now is, rather than trying to do anything exotic in
Hmm.
expectation that there might be a certain outcome in the future, it's important to go back to basics. Look at how valuations are, look at how earnings are, and try to ensure that you don't try to shift your strategy too much. So, for example, if you're running SIPs, because there is an expectation that markets could be heading downwards, don't go and stop your SIPs. Similarly,
Hmm.
if you wanted to invest lump sums, uh, you know, don't stop investing those lump sums just because you expect the market to go down, because you have to get two things right. You have to get the market going down to a certain level, and then you have to get the re-entry back as well. So let's say you decide that I want to enter the markets when the Sensex is 75,000. I'm just using it as an example, right? And the markets actually go down, but they go down to 75,500, but they don't go to 75. And then they go back up from there. Now you've done nothing else, but you've paid taxes because you exited your portfolio, and maybe then you're going to buy an even higher level. So I think it's really, really important that you don't try to do too much in this time. I think one of the things we've seen is around big events, the lesser you do as an investor and the lesser you try to change strategy, the more likely that your outcome is going to be better.
You're right. In fact, I so agree, right? The more decisions you take, the more chances of failure. It's just keeping it as simple as that. And you call this, and I think a lot of people don't get this. That's the other big problem with sectorial funds. You got to get the entry right and the exit right. Now, suddenly between yesterday and today, everyone is talking about how IT sector is out of the woods. I spoke to a few managements and they said this is euphoria. Till things start changing, we're still at least 5 to 6 quarters out. But the markets, I guess, to some extent, are rejoicing the fact the overhang is behind them. Now, if IT is going to do well under the Trump Raj, do you think adding sectoral funds like IT is a good idea? You can start by telling me whether adding sectoral funds is a good idea, and if yes, would you recommend adding IT?
So I think it again needs to go back to valuation, because ultimately the way we look at it is, whatever decisions you end up making need to come from where valuations are. If you look at sectoral valuations, including IT, you'll find that outside of private banks, virtually all sectors are quoting at anywhere between 20 to 35, 40% premiums to their 10-year averages. And therefore, you generally have a fairly expensive marketplace, including for IT. And therefore, our suggestion right now is that rather than trying to again go in and pick a sector, if valuations are expensive, you want to stay away from trying to pick a sector because you're already buying something which is expensive. Maybe markets were pricing in, something else, which was not a Trump election earlier, but the prices have become high because of that. And therefore, we would say that, avoid getting into any sectoral space right now. Uh, if you have to get into a sectoral space, then don't try to be tactical about it. If you believe that, for example, um, digitization or any of the spaces that tech firms are going to move into, let's say AI, wherever spaces are, and you're trying to take a bet that over the next 10 years, for example, there is money to be made, then I think that is a good approach to take rather than trying to do a tactical bet saying because Donald Trump has come back,
Hmm.
because there's probably going to be a tax rate cut in the US, because there's going to be a tax rate cut in the US, companies will have money to spend and they will put that money into, giving projects to Indian IT companies, and therefore they will do better. I think that's got so many layers of, if this happens and then that I think you're exposing yourself to risk automatically because you're buying at high valuations.
Hmm. Vishal, we started and you alluded to this, and I'm sort of glad you did, right? And in the last 10, 15 years that we've tracked it, we haven't talked about global allocation as much as we have probably in the last few months. With China's resurgence, there was a little bit of excitement around getting into a Nippon Hanseng ETF or looking at a fund of fund. While funds like Parag Parikh have held a global allocation for quite some time, and that's been one of the key reasons why they've outperformed as well. And like you said, right, US markets, the mother market, has always done well in more cases than not. The case in point, the NASDAQ has done better than the Nifty this year too. Do you feel with so much of conversation and focus around the US markets now doing well, it may be a good time if one has already not done this to add a global exposure? And if yes, what is the best way to do it? Do you buy an ETF? Do you buy a fund of fund? Or do you simply invest in a Parag Parikh Flexi Cap fund, which is 25% allocation to the US markets?
So I think it's a great question. I think it's never too late to build a more global portfolio. I think you spoke about this earlier, saying a lot of our expenses today are anyway likely to point towards having some dollar element to it. So you're not only getting the benefit of buying into a different market, but you're also probably buying in some protection for the rupee, which has traditionally been a weaker currency. The way to do this is actually going to be different depending on what your overall strategy might be. So if you're a high net worth investor who's wanting to think about using the LRS, want to comply with all the tax reporting that you need to do, ensure that the dividends are reported correctly in your taxes, etc., then I think you might consider whether you want to buy ETFs overseas. But if you're thinking that I don't want to get into any of that, I don't have a full battery of people who
Hmm.
can help me through this. I don't even know how much money I want to put away because I'm a retail investor. Then I think those investors are better off either buying US funds that are already available through fund of funds. Many of them allow SIP investments even today, or go out and buy something like a Parag Parikh. Of course, the exposure to international Parag Parikh has dropped considerably
Yeah.
because of the cap that got hit from SEBI perspective of $7 billion for international investments for domestic funds. So over a period of time, the amount of international exposure in Parag Parikh has, for example, dropped to more like around 10% than the
Hmm.
25% that they used to have earlier. But I think it's a good idea for investors to think about either of these two, which is get in a Parag Parikh, which is more India but has a little bit of US, or you get in international fund, because one of the things that held people back earlier, which was adverse taxation if you went to an international fund versus a domestic fund actually went away in the July budget. And therefore, all of a sudden, except for the holding period, which is 1 year for a domestic fund to be long term and 2 years for an international fund, otherwise, the tax rates are the same now at 12.5% long term.
Just to stay with international funds or global allocation, how much, and I know this is also personal because it's not a cookie cutter approach, but for an individual with an average risk profile, we'll keep the expenses out because we really don't know. What percentage of one's portfolio should be allocated to geographies outside India? And what is the best way to do this? Do it through a SIP or do it through a lump sum? And also, more importantly, you talked about international funds. You want to tell us how does one execute that? Would you simply go onto a platform and invest in it? Do you need to open a US account? I'm assuming it's not that complicated.
Yeah, so let's start with the sort of easy part of this, which is
Yeah.
essentially that the SIP route will probably have to be the route that you take, uh, and how much allocation you make, uh, besides many other sort of thumb of rule of thumb sort of calculations. In our view, we'll have to start at somewhere around 10% and maybe peak at 30%. So that's the range of international investment that you might want to have in your portfolio because of the way valuations are in the US as well. So we spoke about the valuation excesses in India, probably some of which is now starting to create its own challenges. The US markets are not cheap either. So they are also about 1.25 standard deviation above their long-term average. So you are also buying into an expensive US market today, and therefore the SIP route, or if you prefer an STP because you have lump sums of money, I think that route is a preferable route to build out your 10 to 30% exposure, depending on what you want to do. Additionally, I would say that in spite of all the negative news around China at this point in time, because of the expectation of what will come next in the Trump administration, we do want to keep in mind that Chinese equities are at valuations which are much lower than their long-term averages. And there is a lot of conversation around more stimulus to come out of China as well to revive the economy. And therefore, we would say that as you build out this international portfolio, you may not choose to restrict yourself only to the US. You could either do the US if you just feel more comfortable there, or you could look at even there are funds which do developed market investing, which are a combination of multiple developed markets. And then there are emerging market funds and China or Greater China funds as well. So I think for each investor, they'll have to look at this, like look at the India portfolio and say, I want 3, 4, 5 funds in the portfolio. They will also want to do the same thing with the international side. With respect to the LRS route, they will have to open an account with a platform which allows global investing. Uh, and typically, then they want to be able to add what they want to add overseas. The challenge for them is the number of options are very, very high. So the starting point for them to begin with their international allocations may have to be either a S&P 500 based index ETF or a MSCI World based ETF, so that they can start off their exposure with well diversified names and not start off with sectoral picks. I mean, we see investors say, hey, you know what, semiconductors have a great story ahead. So why don't we make our first international investment as a semiconductor ETF? I mean, I don't think that's where you need to start. I think just like you build out a robust India portfolio, you need to also build out the international piece in a robust manner. At some point in the future, you might evaluate thematic or sectoral options there as well. But clearly, that can't be the starting point.
So I think a good starting point would be to build out a core portfolio and then put the pieces of the satellite together, maybe at a later stage. Vishal, I'm going to be maybe potentially out of time, and I'd love to talk to you about debt because that is a whole beast in itself. And with everything that's expected from the Federal Reserve, there will be an impact on the debt markets. I know for the last few months, we've been hearing about advisors recommending debt allocation tactically as well. Of course, strategic debt allocation has got to do with what your portfolio is and what your objectives are, or asset allocation. Do you think tactically, given that the Fed will aggressively cut rates over the next couple of days, uh, the RBI potentially could follow? Because, like we said, earnings have also not impressed significantly and consumption is slowing down. Keeping that in mind, would you recommend investors to add to medium or long term debt funds for the next 18 to 24 months? Very specific, pointed question, but just trying to understand how one should play debt tactically at this stage, if one should play debt.
So I think there are two elements here, right? One is growth and the second is inflation. And one of the things that RBI has constantly been talking about has been that they don't believe the inflation monster has got fully bottled up. And I think a lot of what is being talked about today, as possible changes in the Trump administration going forward, could end up being very inflationary, including, fiscal uh, steps going out of control. And therefore, one of the things that we'd suggest to people is that only if they have high risk tolerance do they actually try to play a long term debt story. Because what you're doing is very, very importantly, a lot of investors tend to have risk appetite as far as their equity allocations are concerned. But with debt, they tend to not have the same sort of risk tolerance. And therefore, the way to think about the debt side is, uh, have most of your money in short-term debt. If at all you want to tactically allocate, you can tactically allocate maybe up to 20% of your money to long-term debt to hope for some capital gains to be made over a period of time. But be very mindful that the rate cuts may be much shallower as compared to what people were anticipating originally.
Right. Also, goal becomes important to talk about, but maybe we leave that for another day. What I do want to ask you, which I think would be useful for our viewers, is very simply put, right? One, if you're an existing investor, and one, if you're a new investor, somebody who's decided to start investing starting tomorrow, say, what would your advice to them be at this juncture, keeping in mind global and local factors at play? Do you rebalance your asset allocation? Do you stay put? Do you add incremental capital to equities? What would you do? Or what should
So
you do,
I
rather?
think it's, yeah. So I think the first thing, like I said earlier, is try to do very little. Don't try to shuffle your existing portfolio too much. I don't think what happens with a president coming in necessarily impacts markets as significantly as it may appear in a day or two. So don't try to do too much. For monies that continue to come into you, please ensure that you continue your SIPs. For monies that are sitting with you already, which you were maybe waiting clarity on what happens in the US election, etc., is, do allocate them, but be mindful that because equity valuations continue to be high, in spite of the recent sort of 7-8% correction from peak, if you want to go lump sum, please try to go through a hybrid instrument. Maybe look at a balanced advantage fund in your portfolio. If you're not going hybrid but want to go lump sum, then try to go in through a systematic transfer plan so that you go in gradually and get the benefit of rupee cost averaging.
I'm glad you bring that up because I think do as little as you can. Don't get carried away with all the noise. If you're an investor, you need to spend time in the markets, take advantage of opportunities that show up. And sometimes, of course, what you also need to do is talk to your financial advisor. That's most important. But Vishal, a couple of questions that have come in. Vineet Patel writes in, and he asked a question pertaining to what you just said. Says if rupee is expected to depreciate, should we park money in international funds? We talked about this, but you want to elaborate on it a little bit more for Vineet?
So it certainly is helpful if the rupee depreciates for international funds. But what you need to remember is that when you buy an international fund, you are buying equities. So what ends up happening is that the rupee depreciation, while it positively impacts the return on your fund, on the other side, you have equity market movements which could actually positively or negatively impact your fund as well. So the net outcome you will get will be a combination of the performance of equity and the performance of the rupee against the dollar. So there's no way for you to buy the rupee dollar easily in just a standalone format. And what we also need to remember is that very often, uh, when there are fiscal challenges that start to emerge, those are actually bad for the currency. So if the outcome of what is getting talked about in the US plays out, after an initial period of dollar strength, you could actually end up seeing dollar weakness, in which case the rupee actually starts to strengthen, and that works against international funds. So our suggestion is don't try to, build your investment strategy on the international side based on what happens in the rupee dollar.
Right, we have one quick question and completely out of time, so I'll just do one more. Actually, Nidhi Singh writes, in which asset class is more vulnerable to events like US elections, Vishal?
So typically, what will happen is any growth asset, in our view, is subject to this risk, and you can see this growth asset risk playing out in the way equity and gold are behaving. So traditionally, I think the way people have thought about gold is, it's a very safe asset. That's how that's what we've heard commonly. I think the reality around gold is that gold can also be very volatile. Like you saw, you've seen gold like lose more than $100 in a single day yesterday. So the way to think about this is, because equity and gold tend to be inversely correlated, you should expect that whenever an election outcome happens, both of these assets can be fairly volatile. In fact, all commodities can end up being volatile here. So the way to think about it is both equities and commodities, including precious metals, are probably the more volatile assets and get impacted whenever events of this kind happen.
Yeah, and they've got so much that is turning things around on their head. We've seen gold selling off, silver picking up. But Vishal, I would, of course, I can go on and on with our conversation on personal finance. But thank you for taking the time out to talk to us. We'll hopefully catch you soon.
It's a pleasure. Thank you so much.
Thank you.